Tonight, something critical, something truly structural is unfolding in the silver market. And to see it, you need to do something counterintuitive. I need you to look away from the ticker. I am serious. Close the tab on your browser. Turn off the CNBC price feed. Smash the screen if you have to, because right now, the number flashing in green or red on your screen is lying to you. And worse, it is dangerous. It is a fabricated signal designed to induce panic in the uninformed while the smart money exits the burning building through the back door with the physical assets. Welcome to Veiled Wealth. It is December 30th. We are sitting in the liminal space between the old world and the new. We are less than 48 hours away from the new year, but more importantly, we are 48 hours away from a geopolitical event that historians will look back on as the moment the silver market fractured, the China export ban going live. Yet, despite this seismic shift, my inbox is flooded. I'm getting hundreds of emails from you guys, loyal subscribers of Veiled Wealth, saying things like, Asian guy, I went to my local coin shop today. I tried to sell some rounds to cover holiday bills, and they offered me $4 under spot. If there is a shortage, why won't they pay me? Why is the price going down? You are confused. You are scared. You are looking at a chart that says one thing and a physical reality that says another. You think maybe the shortage is fake. Maybe the squeeze was just a YouTube myth. Maybe the influencers lied to you. Listen to me very carefully. This is not a bear market. This is not a correction. This is a market freeze. The complex invisible plumbing of the global silver market has snapped. The reason your local dealer won't pay you spot price isn't because silver is worthless. It's because they are full. They are broken. They cannot hedge their intake. The entire mechanism of turning physical metal into fiat currency has ground to a halt. To understand why your dealer is offering you insultingly low prices, we have to peel back the layers of the industry. We have to look at the unsexy, boring logistics that actually move the world. The backlog at major refiners we are talking about, the giants like Valcambi, Asahi, Heraeus, has hit 14 weeks. Let that sink in. 14 weeks. That is a quarter of a year. In a normal market, this backlog is days, maybe a week. Here's the simulation of what happens when you walk into a coin shop today. You put a tube of silver eagles on the counter. The dealer looks at it. He knows he can't sell it to a retail customer because everyone is selling, nobody is buying. So his only option is to sell it up the chain to a wholesaler. The wholesaler takes it, but his vaults are full too. He needs to send it to a refiner to be melted down into 1,000-ounce commercial bars. But the refiner says, stop, we are full. We cannot process your metal for 3 months. Now, put yourself in the shoes of the dealer. If he buys your silver today at spot price, he is holding a volatile asset that he cannot turn back into cash for 90 days. That is a liquidity death spiral. No business can survive buying inventory they cannot sell for 3 months while the price fluctuates wildly. So he does the only thing he can do to survive. He lowers his bid. He offers you spot -2, spot -4. He is pricing in the massive risk of holding that metal during a market collapse. He isn't trying to rip you off. He is trying not to go bankrupt. But here at Veiled Wealth, we dig deeper. Why are the refiners backed up? Is it just too much metal? No, it's a financial mechanism failure called hedging breakdown. Normally, when a refiner buys your scrap silver, they don't gamble on the price. They are engineers, not speculators. The moment they buy your physical silver, they go to the COMEX futures market and they sell a short contract. This locks in their price. If silver drops, they lose money on the physical metal but make money on the short contract. It's a perfect hedge. It guarantees their profit margin regardless of price action. But right now, they cannot hedge. Why? Because the market has entered a state of extreme backwardation and volatility. The lease rates the cost to borrow silver to facilitate these trades have spiked. In some shadow markets, annualized lease rates have hit over 100%. Imagine you are a refiner. You buy an ounce of silver. To hedge it, you have to pay a fee that wipes out your entire profit margin. So you have two choices. One, buy the silver unhedged and pray the price doesn't drop, which is gambling, and refiners don't gamble. Two, stop buying. They chose option 2. They simply closed the gates. I am looking at reports from the ground right now. Major refineries are refusing 90% junk silver entirely. They are putting strict limits on sterling scrap. They are telling wholesalers, don't send us any more metal. We can't process it. This causes a traffic jam. The wholesaler can't sell to the refiner, so they stop buying from the coin shop. The coin shop runs out of cash, so they stop buying from you. This is what we call a liquidity trap. It is crucial that you understand this distinction. It does not mean there's too much silver in the world. It means there is no capacity to process it. It is like a starving man standing outside a supermarket with the doors locked. The demand is there, the starving man. The supply is there, the food inside. But the door, the refiner, is jammed shut. Do not mistake a broken door for a lack of hunger. The world is starving for silver, even if the coin shop door is closed. And amidst this chaotic freeze, look who just spoke up. Elon Musk. Yesterday on X, he posted 3 simple words that should terrify every naked short seller on Wall Street. This is not good. He wasn't talking about Tesla stock. He wasn't talking about politics. He was talking about silver. Elon Musk is not a silver bug. He doesn't stack coins for the apocalypse. He is an industrialist. He looks at raw materials as fuel for his empire. And he knows something that the CNBC pundits are ignoring. He knows that in less than 48 hours, the Chinese supply, which represents nearly 60% of the world's processing capacity, gets locked behind a license wall. Let's talk about the China export ban. This is the elephant in the room that veiled wealth has been tracking for months. On January 1st, China's new strategic resource laws kick in. For decades, China has been the world's refinery. They import raw ore from Mexico, Peru, and Australia. They refine it in massive coal-powered facilities that the West shut down years ago due to environmental regulations. Then they sell the pure 999 bars back to the world. Starting Thursday, that stops. The Chinese Communist Party has implemented a dual circulation strategy. This means resources stay inside to fuel domestic growth. Those bars are no longer for export. They are for Chinese solar panels. They are for Chinese EVs. They are for the People's Bank of China. This creates a bifurcated market. Price A, the China price. High, scarce, protected, driven by physical industrial demand. Price B, the rest of world price. Volatile, panicked, shrinking, driven by paper contracts. The bridge between these two worlds is being burned. Historically, if silver was expensive in Shanghai and cheap in London, banks would buy in London and ship to Shanghai. That's called arbitrage. It keeps prices stable. But with the export ban and strict import licensing, the arbitrage is broken. You cannot move the metal. This means the price in the West is about to become incredibly volatile. It will crash up and it will crash down because there is no liquidity buffer left. The dampener is gone. While the coin shops are fighting over pennies and the refiners are locking their doors, the real war, the war that will determine the next decade of wealth, is happening in the boardrooms of South Korea. We need to talk about Samsung. While you were watching the chart crash during Ghost Week, that holiday period where volume disappears, Samsung SDI quietly confirmed they are moving to mass production of their solid-state battery. The mainstream media reported this as new battery tech. They ignored the most important detail, the detail that matters to us at Veiled Wealth, the anode. It's not graphite, it's not silicon, it is a silver carbon composite. Let me give you the numbers because physics doesn't lie, and chemistry doesn't care about the COMEX price. A traditional electric car, like a Tesla Model 3, uses maybe 20 to 50 grams of silver. It's used in the wires, the switches, the control boards. Samsung's new solid-state battery, it uses 1 kilogram of silver per vehicle, 1,000 grams. That is a 20x to 50x increase in silver load per unit. Let's run the simulation. Global car production is roughly 90 million units a year. If just 1%, 1 single percent of the global fleet switches to the Samsung silver carbon battery, that is 900 metric tons of new silver demand. That is 29 million ounces of silver removed from the market for 1% market share. Now, imagine if it hits 10% or 20%. There's not enough silver in the ground. There's not enough silver in the vaults. There's not enough silver in the observable universe to satisfy that demand at $75 an ounce. This is why Elon is tweeting. He knows that if Samsung locks up the silver supply for their batteries, Tesla is in trouble. He knows that silver is no longer just a precious metal for coins and jewelry. It is now a strategic energy metal. It is the new oil. It is the new uranium. And you are selling it because your local pawn shop offered you spot minus $4. Wake up. Now the skeptics will say, but surely the vaults are full. If the refiners are backed up, there must be too much silver. Let's look at the data, because data destroys narratives. I am looking at the official inventory data from the Shanghai Futures Exchange, SHFE, for today, December 30th. Inventory levels have dropped to 819 tons. Do you know what that number means? That is a 10-year low. In 2021, they had over 3,000 tons sitting in those vaults. Where did 2,200 tons of silver go in just 3 years? It didn't vanish. It went into the solar panels covering the deserts of Inner Mongolia. It went into the stockpile for the export ban. It went into the strategic reserves. We are seeing a run on the bank. But the bank isn't holding cash. It's holding metal. Look at the COMEX in New York, the registered category, the silver that is actually available for immediate delivery against a futures contract is bleeding out. It is hovering near historic lows relative to the open interest, the number of paper claims. For every 1 ounce of physical silver in the registered vault, there are dozens, sometimes hundreds, of paper claims fighting for it. This is a game of musical chairs. The The music is playing, the price is flashing, everyone is dancing. But on January 1st, the music stops, and there's only one chair. The chair is labeled physical possession. So let's talk about you. Let's talk about the knot in your stomach. Let's talk about why you feel like throwing up when you look at your portfolio value today. This is by design. This is psychological warfare. They are gaslighting you, the banks, the media, the broken pricing mechanism. It is all designed to make you feel like you're wrong, to make you feel isolated, to make you feel stupid. When you go to the dealer and he offers you $71 for an ounce you bought at $75, you feel foolish. You think, the market is speaking. The market says silver is trash. No, the market is screaming that it is illiquid. Think about the housing market in 2008. There were days when you couldn't sell a house. Liquidity was zero. Did that mean the house had no value? Did it mean the roof wouldn't shelter you from the rain? No, it meant the credit mechanism was frozen. We are in the 2008 moment for silver. But there is a massive difference. In 2008, there were too many houses. They were oversupplied. Today, silver is in a structural deficit. We have consumed more silver than we have mined for 5 years straight. The Silver Institute projects the deficit for 2025 to be over 200 million ounces. Who fills that hole? The mines are flat. Output in Mexico and Peru is declining due to ore degradation and strikes. The stockpiles are empty. Shanghai is at a 10-year low. London is opaque but draining. The only person left to fill the hole is you. They need your stack. They need you to get scared. They need you to look at the ticker, see the red line, panic, and sell your eagles to the refiner so they can melt them down and send them to Samsung. That is why the buyback price is low. It is a demoralization campaign. Do not let them win. We are in the final hours of 2025. This has been the year the mask slipped. We saw the COMEX margin hikes designed to kill rallies. We saw the JP Morgan spoofing cases confirmed in court. We saw the inventory drain. And now we are staring at January 1st, the China ban, the return of the institutional buyers, the Samsung pivot. Tonight, I want you to step back and reframe your identity. If you hold physical silver, you are not a speculator. Stop acting like a day trader. You are a central bank of one. You hold the only financial asset that is simultaneously 1. Money, a store of value for 5,000 years. 2. Strategic commodity, the absolute requirement for the green energy revolution. They can print dollars. They can print euros. They can print yen until the ink runs dry. They can even print paper silver contracts on the COMEX and sell them to unsuspecting ETFs. But they cannot print a silver atom. They cannot print electrical conductivity. They cannot print the laws of physics. The refiners are broken because the physical demand broke them. The dealers are panicking because the volatility broke their business model. But you don't have to break. You just have to sit tight. You just have to realize that the spread, that agonizing gap between the paper price and the physical reality, is not a sign of failure. It is the measure of their desperation. It is the cracking of the dam. Do not sell. If you can find metal and you have the dry powder, buy it. But whatever you do not look at the ticker and think it represents value. It represents war. And we are winning. Happy New Year, stackers. 2026 is going to be the year the dam breaks. Class dismissed. Stay informed, stay engaged, stay curious.